Hi, my name is Scott Dahl. Thanks for tuning in to another one of my podcasts. I'm recording this on Monday, August 5th, 2024. What happened to the market, right? It was, everything was going great. There was no real negativity that you could see around the corner. So what happened? What prompted this sell-off? Well, nobody really knows what's creating this sell-off because there are so many factors that go into the price of the market. But more than likely what happened is it was a job report last week. If you can see on the screen, you see July 24th, U.S. economy added 114,000 jobs that month, the month of July. They were expecting to add 175,000 jobs. So it was significantly less than what they had anticipated, which would indicate an economic slowdown. Also, they revised the numbers for May and June, collectively down by about 29,000 jobs. On top of that, unemployment ticked up to 4.3% and wages ticked up about 0.2% over the month. So this weaker than expected report was a very surprise to what it ordinarily or what had been relatively robust job market. So the slowing data indicates that the Fed perhaps should have started cutting rates sooner than they had been. Their next meeting is September 18th, and investors are starting to worry that perhaps the Fed hasn't cut soon enough. And that's a typical pattern with the Fed in the past, and with perfect hindsight, that they just don't quite get there fast enough to cut the rates to keep the economy humming along. So the odds of a recession in investors' minds have increased significantly because the Fed has a dual mandate. So you hear all this talk about the Fed fighting inflation. Well, they also have a mandate to keep our maximum sustainable employment rate. So if jobs are dropping significantly, then that's a negative sign. So then the question is, on September 18th, is the Fed going to cut 0.25%? Are they going to cut 0.5%? And the big question again is, are they going to be able to cut quick enough to avoid a recession? So who knows what can happen in the future economically? So what the market did is it went from being overvalued and pricing in this Goldilocks scenario where it was going to be a soft landing or no landing. The economy was just going to kind of soften up and just kind of keep growing to a recession. So they went from the best case scenario to worst case scenario. Market has a tendency to overreact. So let's take a look at the market. What I've got up is a chart of the Standard & Poor's 500. You can see that we had a peak right up here. The date was July 16th, and then we started this sell-off, and it has just precipitously dropped. So where are we headed from here? Well, this is 23% back, 50% back, 61.8% back. These are Fibonacci support levels. We've cleared that. There's really nothing to support this market down to this level, 4,972, and then down to this level, 4,813. Where do I get this 4,813? Well, if you look at more data, this was the high that was set back in January of 22, and that's going to become support. So I'm going to blow this back out so we can look at it further. We're still on a daily chart, S&P 500. Here's November of last year. What I've drawn is a 45-degree angle, which would perhaps be a reasonable trajectory for the market. So you can see that this is kind of where this soft landing kind of got set in investors' minds, and we continue to move away from what might be more of a normal trajectory. So what the market does is you've got this normal progression line, and then you've got, it's like a rubber band. It pulls too hard far one way, then it pulls too far the other way. So the two prominent emotions are in the market are greed and fear. We were in a greed phase, and now obviously if you see these sell-offs right here and you see these gaps remember, gaps can be good on the upside. They can be bad on the downside. See the gaps between the days here? So these gaps show that there's significant fear in this market. I guess the question is, what's going to happen now? What I have up now is a chart of volatility. It's the VIX. And the VIX typically almost always moves opposite of the stock market. What I've drawn in here, I've drawn two lines. This is you see this bottom line and top line. So this is sort of a channel that the VIX has been traveling in. So every time it breaches this line, then we are in the midst of a decline. We might be near the bottom of the decline, but what I wanted to do is take these points, these 1, 2, 3, 4, 5, 6, here's current, take these points, go back through past history, and just take a look at when we had this high volatility that broke this trend line, what happened to the market. So let's go back to the S&P. So what you have up here is I have a weekly chart of the S&P 500, and I've drawn these vertical lines in every time we had this volatility spike, just to kind of give you an idea of what kind of action we might be looking at. So you can see that this strike up in the VIX that is so concerning, it happened back in 2008, right at the midpoint of what was a significant down move. move. Here it happened again in the midpoint of a down move. Here it sort of happened at the right at the, I'm going to blow this up a little bit. So it's right perhaps at the bottom of the down move. Here it happened at the bottom of the down move. Market recovered and came back through. Let's move forward. So here it happened at the midpoint of the sell-off. And here it happened this is the most current, 2021. It happened at the dead bottom of the sell-off. So the question is, are we at the bottom of the sell-off? I don't think so, because of the nature of the sell-off, the fact that the breadth has been dropping down. So I unfortunately believe we have more to go. That's the odds of probability. I could be wrong. It could turn tomorrow, but I don't see that. So one thing that's very important, you've got to make sure that your portfolio is in the strongest stocks or strongest financial instruments, and a well-balanced portfolio to be able to ride through this. If you're sitting on some stocks that aren't necessarily the strongest or the greatest things, you're probably going to be going through a lot more pain than what you would have to go through during the sell-off. Also, I want to point out that sell-offs are a normal part of the process, because Charles Dow pointed out that they're like a steam valve on a boiler, where the steam builds up and then you let the steam out. And what it does is the boiler settles back down and it can make that next move higher. So you need to purge the speculative excess out of the market in order for the market to go higher. These aren't fun. They're painful. But if you're allocated properly, then you should be able to ride through these sell-offs. So the question is, how much further down are we going? Nobody really knows, but I think that there's more potential downside from these levels. I guess I want to leave you with this. We've got two things working on us right now. Number one is the stock market, between the point that the Fed does the last rate hike, between that and between the rate cut, that's typically when you see the maximum amount of performance. And we've seen that. We've seen a very strong market. So when the Fed cuts, what's going to happen? Typically, from the time the Fed does the first cut, you have about a 23% sell-off from that point till the eventual bottom. So that doesn't necessarily mean that when they do the first cut, that's going to sell the market off. But the subsequent cuts could potentially create a sell-off in the market before we start back higher again. Remember, I believe we're in a shorter term, we're in a cyclical bull market and an overall high inflation, high interest rate, secular bear trend. But I do think the cyclical bull market could continue further. Let's look at one more thing. So I've got a chart up. This comes from Scott Brown, a fellow CMT. He's a good technical analyst. But if you take a look at this chart, the market starts selling off right about here. This is week 37. So week 37 is typically September 15th. So something got us going down a little early. Nothing's going to be perfect. The election year seasonality, yeah, this is what we've had historically when we've combined them, but nothing's going to be absolutely perfect. So there's a good probability or good possibility we could sell off into September, October. But what typically happens is right before the elections are finished, and then after the elections are done, regardless of who gets into office, we see this massive move. So we're probably going to see some type of election seasonality sell-off here, and it could quite possibly be painful. It looks like where we're headed, but then we should have a significant rally if election year seasonality holds up, and then potentially rally into the next year. So I think this bull market, this cyclical bull market, has more to it, but this has definitely increased the probability of a recession, which obviously the market's not going to like. And I'll say this in closing, that remember, the market is a leading barometer of economic activity. It's a forecaster of economic activity. So if we're going to have a recession coming up here, which the odds have certainly increased, then the market's picking that up and it's pricing it in now. So that's what we're looking at. If you have any questions, give me a call. It's 949-497-6366, dahlcapitaladvisors.com. Be happy to take a look at your portfolio for you. Make sure you're allocated properly, that you're in good assets. All you got to do is give me a call and we'll take a look. So thank you again for tuning in. I hope this has helped, and I'm going to look forward to the next broadcast in the future. Thanks.